All right, welcome. This is our institutional briefing on the 2026 investment thesis for North Bangalore. We're going to skip the fluff today and get right into the hard data that defines this massive opportunity.
So, what are we seeing for 2026? Well, it's nothing short of a fundamental shift in the city's economic gravity. Think about it. Eastern hubs, like Whitefield, they're pretty much hitting their saturation point. But the city's real momentum? It's all surging north, and it's undeniable. And look, the numbers back this up. The North Bangalore impact zone is growing at an incredible 15 to 20% year over year. That's effectively double the city's average. This isn't just random sprawl. This is a carefully planned economic transformation.
Okay, now this is where timing becomes absolutely critical. We are currently in what we call the infrastructure gap. You can see it right here on this S-curve. The physical construction of these key projects, it's about 90% complete. But the market's perception of that, the actual capital value, it's lagging way behind at around 65%. For any strategic investor, that gap is the golden window. It's a chance to get in before the market fully prices in this brand new operational reality.
So you might be asking, what's actually driving this incredible value gap? Well, it really comes down to two main engines of growth. First up, let's unpack these massive infrastructure projects that are basically acting as powerful economic multipliers for the entire region. Right at the very heart of this thesis is the transit spine, the 58-kilometer Blue Line Metro. And let me be clear, this is not just another project. This is the single most important value unlocking mechanism in the entire city. Why? Because it directly solves the number one pain point, commute times. So as these phases start becoming operational from late 2026 and into 2027, we're projecting some really aggressive waves of appreciation. We're talking year-on-year premiums surging between 15 and even over 20% for properties right in its immediate impact zone. And this value unlock gets amplified by these new perimeter rings. The Satellite Town Ring Road, or STRR, is completely reshaping the landscape by diverting all that heavy commercial traffic away from the city core. This does two things. One, it makes the area much more livable, and two, it's a direct catalyst for plotted development. At the same time, you've got the inner peripheral ring road completing the loop, seamlessly linking up all of Bangalore's major tech corridors. It's a game changer.
The final piece of this infrastructure puzzle? It's tackling congestion head-on. These new subterranean corridors, like the 17-kilometer tunnel road, are engineered to completely bypass the city's worst bottlenecks. This multimodal approach doesn't just ease traffic. What it really does is solidify Hebbal's position as a permanent, high-liquidity gateway to the north. And that means it will always be a central, easy-to-transact hub.
All right, on to the second engine. And this one is arguably even more powerful. This isn't just about new roads and metro lines. This is about overwhelming commercial demand that is creating a massive structural housing deficit.
You have to remember, Bangalore was still the undisputed capital for global capability centers in India. It absorbed a staggering 12 million square feet of office space in 2025 alone. And who's the primary beneficiary of this boom? North Bangalore. Why? It's simple, really. It has the large, grade A floor plates that other saturated corridors just don't have anymore. The 3.1 million square foot expansion at Manyata is a perfect example. And we all know, where commercial real estate booms, residential demand is sure to follow.
And this is a really critical distinction to make. We're not talking about a software-driven boom where hybrid work is an option. Nope. We are talking about hard tech anchors, companies like Boeing, Collins Aerospace, and that massive Foxconn iPhone facility. These are physical manufacturing and R&D campuses that absolutely mandate on-site presence. And that guarantees aggressive, non-negotiable local housing demand.
And this is the direct result of that hard tech boom. By 2030, we're projecting a workforce of 400,000 people in North Bangalore. Now compare that to the currently planned gated inventory of only 70,000 homes. The result is a jaw-dropping deficit ratio, 5.7 jobs for every single available home. This isn't just a housing shortage, folks. This is a structural undersupply that mathematically guarantees two things: aggressive capital appreciation and near-zero vacancy rates for investors.
So we've established the big picture, the macro thesis. Now let's translate this down to the ground truth with a really granular analysis of the three key investment pockets.
Okay, on the ground, we can basically segment North Bangalore into three distinct investment corridors, and each one has a totally unique profile. First, you've got Hebbal, the established luxury gateway. Then there's Bagalur, the high-velocity industrial hub. And finally, Devanahalli, which is the emerging Aerotropolis. Each one of these serves a different investor strategy. Let's dig into the numbers.
Let's focus first on Bagalur, because really, this is the core of our investment thesis. The project data here reveals a very clear pattern. If you look at the 2026 quote rates from Tier 1 developers like Port of Ankara and Prestige, they're hovering in that 10.5 to 11.25 thousand rupees per square foot range. This creates a sweet spot bracket between, say, 85 lakh and 1.8 crore. And that price point is seeing just incredible absorption from this new hard-tech workforce.
And here is exactly why that data is so compelling. The growth is anchored by the 3,000-acre KIADB Aerospace Park. What we're calling the Foxconn Effect has created an immediate and severe housing deficit. This has led to the highest rental yields in the north, and you're seeing units from developers like Godrej and Brigade selling out even in their pre-launch phases. The demand is just red hot.
Now let's contrast that with Hebbal. As we look at its project data, the numbers tell a completely different story. This is a mature, premium market. Entry rates from the top developers are already well over 16,000 rupees per square foot. You've got luxury projects like Phoenix One West hitting up to 26,000. So the sweet spot here is in a much higher bracket, typically starting around 2.5 crore and going way up from there.
So to sum up Hebbal's position, it's a high liquidity, very stable market, but that phase of speculative capital growth, that has passed. The investment thesis here has totally shifted. Now it's all about securing strong, reliable rental yields, primarily driven by the senior management from the nearby Manyata Tech Park. It's a stable portfolio hold for sure, but it's not a high growth play.
Our third pocket, Devanahalli, presents a real focus on scale. The data here is dominated by these huge integrated townships from brands like Birla, Tata, and Embassy. And notice the product mix. It's a blend of apartments, villas, and plotted developments. The sweet spot is somewhere between 1.5 and 3.5 crores, and that's strategically designed to cater to the families of this emerging Aerotropolis workforce.
This slide really explains the core wealth creation story in Devanahalli, which we're calling acre to retail. Now, while apartment prices have seen some healthy growth, maybe 25 to 45%, the real story is the underlying raw land value. That has surged 80 to 120% since just 2023. This foundational land appreciation is what created the financial muscle for today's large-scale projects, making this the definitive long-term play for 2030.
All right, now any credible briefing has to address the risks. So let's be transparent and unpack the key red flags that investors really need to consider before deploying any capital here.
We have to be really clear about two main structural risks. First, there's legal litigation. The 1,200-day farmer protest over land acquisition in Devanahalli is a serious precedent. Second, severe water scarcity is a present reality, not a future problem. The Kaveri Stage 5 pipeline is only at 50% activation. So for any investor, the mitigation strategy here is non-negotiable. You have to stick exclusively with Tier 1 developers. They're the only ones with the dedicated legal and logistical teams and the proven track record of navigating these exact challenges.
So, let's put it all together. What is the actionable verdict? It's time to synthesize all of this data into a clear, final recommendation for strategic action.
This summary table just makes the case crystal clear. When you compare the primary drivers, the rates, the yields, Bagalur just stands out. It has the lowest average entry rate, the highest rental yield potential at over 5%, and the highest appreciation potential, which we project at 12 to 15%. It checks all the boxes.
And here is the forward-looking quantitative payoff. Over the next 24 months, from 2026 to 2028, we are projecting a massive 32% value delta for benchmark projects in Bagalur.
Now, it's vital to understand this isn't just speculation. This is a projection that is mathematically underpinned by two scheduled events, the synchronized launch of Metro Phase 2B and the full operational scaling of the KIADB industrial zone.
And this brings us to our final unambiguous conclusion. Our analysis confers an aggressive buy rating for the Bagalur aerospace corridor. It represents the perfect convergence of everything we've talked about: the lowest viable entry price, the highest velocity of job creation, and that impending catalyst of Metro Phase 2B. It's the sweet spot.
So we'll just leave you with this one final thought. In a market that has a structural jobs-to-homes deficit of nearly 6-to-1, is the real risk in North Bangalore actually investing? Or is it the opportunity cost of not investing at all?